to be in English. It's on the twist on corporate strategies, but we did just start off with the PAR video on the announcement that we increased our dividends 25 basis points, which is effective April 1st this year. And why were we able to do it? Mainly due to we see the rising interest rates, and we've had strong real estate and equity performance in the past, and this represents about 30% of our PAR account. As well, because we've had past, for those who've purchased a PAR product prior to 2004, we are giving additional dividends on top of that. Now, whenever we see a dividend announcement, most advisors just pay attention to the dividend rate, and that contributes to about 70-75% of the dividends credited to the policyholders. But in addition to that, 20 to 25% actually represents the experience from other factors such as the mortality, lapses, expenses, policy loans, taxes. And we don't always adjust that every single year, but we have done that this year. So as a result, you will see an increase in dividends for most clients. You'll see more of an increase on the PAR accumulator than the PAR protector. That's because of the policy loans. So more policyholders have taken out policy loans on the accumulator, and due to the increasing loan rates, that actually helps count. Now, those who do not see an increase in the dividends, who are those people? Those would be the smokers. So the smokers actually had poor experience, and so because of that, the net result would be a decrease in their dividends as illustrated. Now let's get into the twist on corporate strategies. A quote I like to show in some of my presentations is that complexity is your enemy. Any fool can make something complicated. It's actually hard to make something simple. But over the years, I've been seeing more and more strategies being created out there in the industry that are getting very complex. And the advisors sometimes get their hands on it and show it to me and say, can you build something like this? So perhaps when I build it, it's to demonstrate whether it actually works or not. But do clients want to buy something they don't understand? Because what often happens is that a year later, they may come back to their advisor and say, why did I buy this again? Or what am I doing here? And they may have buyer's regret and want to actually cancel their policy. And sometimes this may even happen immediately after they purchase the policy and look at the strategy that they've been shown. So we want to make sure that the clients are happy with their purchase, and it's best to keep things simple so that they remember it and see the benefits of that. So on the agenda, I'm going to go through three things. First, we've seen the increasing IFA strategy. And over the last couple of years, I've been having more and more requests from advisors who want to show the IFA with shareholder borrowing. Now, currently, our strategy right now is the immediate finance arrangement with corporate borrowing, but now they want to see shareholder borrowing. Why do they want to see that? Well, I'll show you why, and does it work? Next, it's about purchasing a PAR policy if they have the money, but often term is the much cheaper alternative. So an client may say, well, why don't I just buy the term today, and then I'll convert it later and buy the PAR policy later on. Does that make sense? And if they have the money, should they just buy the PAR today? And then I'll go through some other strategies. Usually it's our most common ones, but I'll put some enhancements to them that will help resonate with the accountants on why the insurance makes sense. So first, let's get into the corporate IFA with shareholder borrowing. I wanted to start off with this slide. This slide shows our top 10 sales last year at Sunlife on the independent side. You can see that the number one was just over $9 million of annual premium for a 53-year-old. And this might necessarily mean just one single policy, but it could represent multiple policies for the same insured, where they may have purchased it in each of their holding companies. And as you can see, all of them are corporate owned, because corporate owned is a corporate owned insurance policy certainly makes sense when they hope to extract that money upon death out of the corporation. They see the benefits of that CDA credit where they can get most or all of it out of the corporation tax-free. So with the top 10, it's not by policy, and you also see that they're all independent, and so none of them were sold by bank specialists. Now, with these, 47 policies in 2022 were over $1 million of premium, and of those, about 17 were par and 3 were UL that were actually IFAs. So almost half of them were sold using the IFA strategy. And with IFAs, we can see the increasing popularity of IFAs. I know with our sales team, about 3,000 IFAs a year, but this is the number that actually get implemented each year. So 2021 was almost double the previous years, probably the most we've seen. I haven't seen the 2022 number, but towards the end of 2022, we saw that loan rates were already starting to go up. And when I look at the historical prime rate, because loan rates are tied to prime rate, which is a short-term rate, and then dividend rate is actually tied to long-term rates. So they don't always trend in the same direction. Sunlife came back out with par in 2010, asked to build the IFA model in around 2012, when the other carriers, the main carriers, Manu and Canada Life, did have an IFA tool available. And that's where we've seen the increasing growth of IFAs. And it makes sense because when you look at prime at that time, prime was even lower than it was the last couple of years. It was actually 2.25. In the last few years, it's been at 2.45. So we saw that the lenders were even lending less than prime for their best clients. And then the difference between that and the dividend rate was 3 to 4%. So now we will probably see a decrease in the number of IFAs being run, but they're still quite our most popular strategy today. So let's go through the process of how the IFA works. Now, the traditional one is corporate borrowing. And what that means is that the corporation purchased the policy on that shareholder inside the corporation. So they pay the premiums and they've been approved for the insurance. And then they're going to use that insurance policy to go and get a loan. They'll sign that policy as collateral to get a loan rate. And with that, once they've been approved, that money will be lent back to the corporation, where the corporation will pay the interest on that loan every single month. And then they will receive tax deductions for the interest on the loan because the money is being invested to earn income. And they'll also receive NCPI deductions. And those NCPI deductions become over time, the net cost of pure insurance deductions. Then at death, the insurance policy pays back the loan, and then the remaining amount goes back to the corporation. Now, what happens is that the remaining amount, the death benefit minus the loan amount, is typically greater than the CDA credit. So the CDA credit allows you to extract up to that amount tax-free. Now, because the CDA credit now exceeds that death benefit minus the loan, then they actually usually have leftover CDA that used to extract other assets out of the corporation tax-free. Now let's look at shareholder borrowing. How does this work? Again, the corporation is going to purchase that policy on the shareholder and own it inside the corporation. Insurance, they will use that policy as collateral to get a loan at an attractive loan rate from the lending institution. But now, instead of the corporation borrowing back those proceeds, now the shareholder will be borrowing that loan that is tax-free. So it's an easier way perhaps to get money, or a tax-free way to get money out of the corporation, because if the corporation took out that money to give directly to the shareholder, they'd have to pay a dividend tax rate of over 45%. So this is a way to get that money lent to the shareholder tax-free. Now, the shareholder is responsible for paying the interest on that loan every month. As well, the shareholder should be a guarantee fee to the corporation, because if it doesn't, it's deemed as a shareholder benefit. Now, I also often get asked question as how much should that guarantee fee be? I've read that it should be somewhere between perhaps 1% to 5% of the outstanding loan. I've also heard that perhaps if the shareholder was able to get an insurance policy being assigned as collateral, they would have to pay a higher interest rate. So perhaps that guarantee fee should be the difference between that, the loan rate they're able to get with it assigned as collateral and the loan rate if there was no collateral signed. And then at death, the insurance policy, the death benefit, the entire amount is paid to the corporation. And so when it comes out of the corporation, they'll have to pay some tax on the excess of the CDA, which is the ACB, the adjusted cost basis. So they will have to pay tax on B if the ACB is greater than 0. And then from there, the shareholder pays the loan. So the shareholder may have to pay that loan out of their own pocket first once it's been called, because it may take a certain amount of time for that insurance death benefit to be paid out. So with shareholder borrowing, there is more maintenance and disclosure required. Financial institutions don't really like it, and as it increases risk, there's a lot of accounting complexity. So the client's accountant would have to keep track of all this. There are increased costs, so we don't often think of the guarantee fee being incorporated when we run the IFA, or we don't think of that there is no NCPI deductions with shareholder borrowing, because even if you are deducting the interest, the owner and the borrower has to be the same person in order to claim the deductions. So now the corporation owns the policy and the shareholder is doing the borrowing, so the lender it's not the same, so they can't claim the NCPI deductions. And because there's more risk, this is actually a copy from Manulife Bank that they require the shareholder to sign off on to ensure that they understand all the risks that they're taking. That this may be seen as a taxable benefit. They want to make sure that they've acknowledged professional independent advice, and so that later on they don't come back and say, wait a minute, what did I get myself into here? So what I've done is I've built a shareholder borrowing IFA tool so that we can look through the numbers and see if it works or not. And so what I've done here is on the left-hand side, you'll see the insurance only. And that is the usual numbers you see on the illustration. This individual was a male 57-year-old who was putting $300,000 into a policy, and these values are shown at the current dividend -1. I'm using Ontario taxes here, and then you can see if they live to 85, their internal rate of return on the net to estate is 3.36. Now, let's say with shareholder borrowing, we're going to look at the costs involved. So they're going to borrow the full amount of the $300,000 a year. I didn't put in the additional collateral they'll have to put up in excess of the cash values for this, but just want to focus on the numbers here. So the loan balance is growing at $300,000 a year, so that after 10 years, they'll owe $3 million. I use a loan interest of 4%, so of course it's much higher today. These numbers are from when I presented at the PD Summit last year. So I'm just using a loan interest of 4%, which was reasonable last year when prime was 2.45. And then a guarantee fee of 2%. So when you add the two, it results in the 6% of your amount loan balance being paid as your net cash outlay, because as mentioned, there is no NCPI deduction allowed, even though there are interest deductions perhaps being taken. But here we assume that there is no interest being deducted because they're planning to use that money to spend as income, that shareholder. At the bottom, you can see the assumptions, but in my model, I can even assign what percentage of the loan is going to be deductible, meaning what portion of that 300,000 is going to be invested to claim a deduction and what portion is not, where there is no deduction. Now, with a guarantee fee, it's not a complete wash because you would think that the guarantee fee is the same person as a corporation. So they're just paying it to themselves. But in reality, that guarantee fee of $6,000 a year, growing, the 2%, is going to be charged as income. So in the first line, you see 6,000, but then the balance is 2,930 because they're going to be taxed on that amount each year. So I'm going to treat that money as coming in net, and then upon death, they will be able to grow that amount after they pay tax on it and earn, and then it will be tacked onto the net to estate when it comes out. So then when you factor all that in and use the net cash outlay of the loan interest and guarantee fee as a money out of pocket being paid by the shareholder, and then the net to estate plus the investment balance of the guarantee fee minus the loan as their money out at death, you look at age 85, and what you see is what you end up with is a 0% IRR. So you went through all that work for 0%, and today, that with a much higher loan rate, let's say 7%, although even though our dividend rate has gone up a little bit, you'll probably end up with a negative IRR for all that trouble. And we haven't even taken into account the financing fees involved with this. So let's go through the differences between corporate borrowing and shareholder borrowing. So is there an interest deduction allowed? For both, yes, if it is being reinvested to earn income. Is there NCPI deduction? Corporate, yes, if there's an interest deduction. No, regardless of whether you're using that money to earn income or not to reinvest. Guarantee fee, corporate, nope, don't need it. Shareholder, yes, you do need to pay to the corp, so it's not seen as a shareholder benefit. Is the guarantee fee deductible? Yes, it is for a shareholder if those loan proceeds are being used to invest to earn income. And what is the purpose of the strategy? Often with the corporate IFA is to take that money borrowed to reinvest back into their corporation. With borrowing, they're often doing it to access that tax-free money out of the corp, or they may be reinvesting it personally. Is there excess CDA? Yes, on the corporate side, because as I mentioned, the death benefit minus the loan often exceeds the CDA. So then there's excess money that they can use to extract out of their corporation tax-free. With shareholder borrowing, no, because they have to first pay, the insurance company pays the death benefit to the corp. The corp has to pay tax on that CB, the excess of the CDA, out of the corp, and then the loan is repaid. And of course, with both, as I mentioned, there are loan financing fees. Usually the first year's financing fee is the most because they have to be financially underwritten, and then it's a percentage of that loan. Ongoing, each year they will have some financial underwriting to ensure that the loan can be paid off, and the banks will do that. Exit strategy. So if they need an exit for the corporate borrowing, often that money has been reinvested into the corporation, so they can just use that money to repay the loan if they need to collapse the strategy. With a shareholder, often that money has already been spent, so they have to think of where they're going to get other money to repay back that loan. Now, if I want to just look at death, let's just look at those numbers again, because I've had a lot of questions about understanding the excess CDA. So let's just look at the corporate borrowing side. For both situations, we're going to assume a death benefit of $1 million. The CDA credit, the capital dividend account, is $900,000. So that means of the $1 million, they're able to extract $900,000 out of the corp tax-free. And the ACB is the difference between the death benefit and the CDA, and that's what they have to pay tax, shareholder dividend tax on. And let's say at death, the loan balance is $200,000, and we're going to use a simple 45% for the shareholder dividend tax rate. So with the corporate borrowing, the net to estate, net to the corporation, after the loan has been paid off is $800,000. The $1 million death benefit minus the loan balance of $200,000. So what is the excess CDA? Well, the CDA is $900,000. So after they've been able to take out the $800,000 after the loan's been paid off, they can take that out tax-free out of the corp. They actually have an extra $100,000 left over. So that means they can use other assets, $100,000 assets to take out tax-free. So they've saved $45,000 in taxes due to this excess CDA being available. So when they look at the net to estate, the $800,000 they're able to get out tax-free, plus they've saved an extra $45,000 from the excess CDA, they have a net of $845,000. Then with the shareholder borrowing, you have a death benefit of $1 million. There is no excess CDA because they have to pay tax on the ACB, which is $100,000. So the tax on the $100,000 ends up with $45,000 in taxes. So the net to the corp is the $1 million minus the $45,000 in taxes, and then minus the loan balance. So you end up with $755,000. So the difference between the two is $90,000. So you have more with the corporate borrowing. And that's only at death. I haven't even factored in while they're alive, the net cash outlay will be much greater on the shareholder borrowing because they have to pay a guarantee fee and there is no NCPI deduction. Now, other twists on the IFA I've seen over the years, advisors get their hands on these other advisors showing these complicated ideas and they're able to sell it, but sometimes I don't even understand what's going on. So what I just went through right now was number one, shareholder borrowing. Number two, shareholder borrowing, but they're lending it back to the corp to invest. So in this situation is that the corporation buys a policy, assigns it as collateral for the shareholder to borrow the proceeds, but then the shareholder ends up lending it back to the corporation to reinvest into the business. Now, that I don't understand because in this case, shareholder, even though they're lending it back to the corporation, they still have to pay a guarantee fee. And then there are no NCPI deductions because the owner of the policy, corporation, and the borrower, the shareholders. So why don't they just do corporate borrowing? So I didn't really understand this, but I saw a company in Calgary doing this. Now the double IFA is two IFAs. So the way it works is that you buy the policy, you borrow back the premium, and let's say you buy it personally, you borrow back the premium to lend it to the corporation to buy another IFA. And I mean to buy another policy which you leverage to reinvest back in the corporation. So this was very complicated, and I feel like this was only done to sell two policies. Number four, split ownership. You may have heard about this one. This is very popular with our top advisor in Canada in that, but it requires an actuary. So you need a corporation owns a policy, but they par policy as if it's a stripped T100. So they have the par and they're able to have the actuary separate it as if it's a T100. Then the shareholder pays the remaining portion of that premium, but gets access to all the cash values, which they will then borrow back. And often that cash value actually exceeds the premiums, the remaining premiums that they pay on that. Number five, IFA for charitable giving. I've seen advisors talk about this. Actually recently built it, so I'll be showing this at our PD Summit later this year. So it's the idea of borrowing the money. So instead of a corporation's personally owned, you borrow it back not to reinvest, but to donate those proceeds charity in order to get a tax credit every year. And then at death, what you're doing is you repay back the loan, and then whatever's left over, you also donate that to charity. So you're donating while you're alive, and then you're donating again at death. And I was very curious about this strategy because it sounded like it could work. So will it? Well, you have to wait till the PD Summit to find out. Number 6, using existing policy as additional collateral. Now, what that means is that your client may already have a policy. So existing par policy. So when they are borrowing the full amount of the premiums, they can only borrow up to a percentage of the cash values. And then they are required to put up additional collateral. Well, why not put their already existing par policy for that additional collateral? Because then they can also get the NCPI deductions on that policy as well. And I actually like this idea. So it was Stephen Sikora, RDAP in the Ontario region, who kind of brought this up to the client. So all in all, we want to just point out that who's monitoring this policy every year, who will take care of it when you retire. Setting up these strategies requires a lot of maintenance and understanding from the client's centers of influence, like the lawyers and the accountants. But these are just strategies thrown out there today regarding the IFA. Now, this one's a little simpler. Also, when does it work? It's about whether the client should buy the par policy today, if they have the money, or buy a term cheaper and then convert it later. And I actually just worked on a case with a regional sales director yesterday on this, because the dad was planning to buy 3 policies for his young adult children in their early 20s, but thought, well, why spend all this money? Why not just buy the term today and then we can convert it later on? So I want to show you 3 options. It's about buying today, buying term and converting later to par at attained age, or buying term and converting to par using the original age conversion. So what is original age conversion? It's, say, for example, the case I was working on was a female 20-year-old, and then you buy the term and convert it later, let's say 3 years down the line at age 23. So they're buying a new par policy at age 23. Or you buy the policy at 23, but you buy it as if you had bought that par policy originally at age 20. And then the Sunlife will expect that you pay the difference between the term and the original par premiums with interest at the dividend rate at that time. So does that make sense? Original age conversion is currently only available for term that is greater than 5 million. So if you are doing a term case, be sure to ask for that available to have the original age put into the contract, because they won't have this available to them if they don't. So let's look at some of the numbers here. We're working on a male 45-year-old here who buys a par today using max premiums plus premiums of just over $300,000 for 10 years. So here you can see this is at current -1, and at age 85, there are %. Or they could buy a same face amount, initial face amount of 5 million, a term policy for only $4,275, much cheaper, $300,000 less for a death benefit of 5 million. 5 years later, they can convert it at age 50, so they are now paying max plus premiums of $351,000, and at death, the internal rate of return is only 10 basis points lower. So it doesn't seem that bad. Now, if I actually took what they paid into the policy and present valued that at 2%, you see that on the left-hand side, buying the par today works out to 2.7 million, whereas if they converted later at a teen age, it's 2.8 million. So they're paying, it's actually about $140,000 more And then when you look at the death benefit, they're getting about $800,000 less. So even though 10 basis point difference, it can add up. Now, another way I like to look at it now, because actually I'll go back to this, because you have different amounts going in, IRR on the death benefit is the only number we can look at. We can't actually compare death benefit and amounts going in to see if it is really a good deal. So what I've done in this case is the same numbers on the left, buying the par today. You see that the IRR is 3.8% and the death benefit is 11 million. You see buy term and convert to par in year 6, and those numbers we showed earlier where the IRR is 3.7. But what I've done now is that the same money going in, I'm going to take that $304,625, and then you pay the term. I'm going to invest the difference, which is just over $300,000. So it's growing in some fixed interest account where you'll be taxed on the interest at 50%, and then using that money to also pay the larger difference in the premiums when I'm purchasing that par at attained age later. So what you see there is that I solve for what do I need to earn on that alternate investment to net me the same net to estate of 11,573 at death and the same IRR. Well, I need to earn actually 9.4% pre-tax on those excess deposits in those first 5 years and continuing on to net me the same. So you're not going to find an alternate investment that earns you 9.4. So if your client does have the money, perhaps buying the par today does make sense, even though the IRRs are so small difference. How about buying the par versus buying the term and converting it original age conversion? So as I mentioned, this individual was 45 and he bought it. So original age conversion means he's going to convert it 5 years later, but it's going to mimic as if he actually had bought that policy at originally 5 years ago. So he's going to have to pay the difference between that 304 and then the term that he's already paid, the difference in the premiums, and then he'll have to pay interest on that, which is at the dividend rate at that time, which is around 6%. So when we compare these values at life expectancy, you can see the internal rate of return is actually the same. So is it worth being able to come up with all that money to pay a lump sum of over $2 million when your internal rate of return ends up being the same at death? And why would someone do this? It's actually usually because they're planning to IFA it, because the differences here is that when you look at the internal rate of return on the cash value, it becomes zero, less negative much earlier. Hold on, my mom just walked in. I'm doing a presentation. So the IRR is now positive earlier, which means that your cash value for that year has exceeded the total premiums you paid into the policy. So you can see it becomes much less negative. And that's why that means they have to put up less collateral. So that's, I would see, would be the only reason someone would want to do the original age conversion. And these are the numbers showing corporate, so it still works. As you can see, the differences in the IRRs of buying par today or buying term and converting later at attained age or original age conversion are all pretty close. Next, let's talk about corporate strategies that resonate with the accountants. Now, we've been hearing more and more about accountants talking about pipeline planning, and that's because if they plan to do postmortem planning, we're often seeing loss carryback, which is what all the insurance companies show in their corporate strategies. It's been approved since the 70s under the Income Tax Act, and you're only subject to the single tax of the shareholder dividend tax rate. And that's usually over 45%. However, the reason why accountants are talking more about pipeline planning is you are also subject to one single tax but that's capital gains tax, which is only 25%. So they see it as, well, I'm now paying 25% instead of 45%. So it's much lower. But none of the insurance companies were able to show pipeline planning. So years ago, when I was working on this big case with the advisor, I worked with Steven Sikora, and we worked on how to build out pipeline planning. And with that, we do have a model available. And what we like to point out here is that you could be, if there is no planning, you're subject to double taxation. So you could be paying capital gains as well as a shareholder dividend tax rate, which may end up paying over 70% in taxes. But your pre-tax, what we do is at Life, we show you if you invested in some fixed income asset, what do you need to earn on that to net you the same as the insurance? So based on these numbers, this showed you that whether you did loss carryback pipeline, your alternate investment needs to earn at least 10%. And then with double taxation with no planning, it has to earn around 15%. So we also have a model here to compare which permanent life insurance product makes sense. And what this shows you is that the alternate investment here is showing percent. So on the loss carryback, they're paying 45% at death when it comes out of the corp. With pipeline planning, they only pay 25%. But yet, whether you do one or the other, this shows you that, or if you do UL or PAR, the insurance way exceeds the alternate investment. So on the left, we just show the net to estate, and you can see it's pretty close between PAR and UL around life expectancy age. And then if the client plans to do, the account decides to do pipeline planning, then here UL is a clear winner. And this is ideal for the client who has no need for cash values, because here we are not taking that into account at all. Another way to look at it, and this is actually, I've seen this at a KLU presentation where Manulife presented, it's about the effective tax rate paid at death. So they're not taking into account what happens during their lifetime, but they're just looking at the bottom there, how much do they have to pay in taxes? So here's the alternate fixed interest investment at 5%, earning 5%, versus UL, and then there's PAR. So with loss carryback on insurance, you have to pay tax in excess of the CDA. So here you can see on a UL 85, there is no, the CDA is now equal to the death benefit, so they pay zero taxes on the UL, and they only pay 1.2% on the pipeline, because with pipeline planning, you are paying taxes on the cash values inside the policy. So with the PAR, you pay, the cash value is growing, so you're paying more in taxes on PAR, but if your death benefit exceeds those taxes, then you could be growing at a faster net than just a level death benefit UL at 0%. So you got to compare the actual net estate values as well, not just look at the tax rates that you have to pay at death. But as you can see, the alternate fixed investment, you're paying taxes with 25% on capital gains on the pipeline. Loss carryback, there is both capital gains as well as the shareholder dividend tax, because it takes into account, you get some RDTOH, refundable dividend tax on hand. You don't pay the full 45% shareholder dividend tax on the full amount. As well, I've also built some enhancements to the current strategies in the software, because to add these enhancements to our software is very expensive. It's easier to just build an Excel tool. And this one's actually the most popular one. So I did talk about the pre-tax investment required. Well, this is just our corporate investment strategy, where you have the alternate investment on the left and then the on the right, but I've added a new column, and it's called required alternate investment rate to match the alternate investment. So it shows in any given year, should you client pass away, how much that alternate investment needs to earn pre-tax to net the same as the insurance. So at age 90, you can see here, it was a joint last to die based on joint age, is that tax needs to earn 12.6% every year to net them the same as the insurance. Because with insurance, we often just show the net IRR, and that's because the insurance typically mostly comes out tax-free, so we don't talk about taxes. But with the alternate investment, a fixed interest, you get taxed every year on the interest, and then you get taxed again at death. So even though this is the loss carryback where you pay a single tax a shareholder dividend tax rate, you are paying while you're alive, and then you pay again when you pass away, and then there is some RD2H. So I have this model here that looks just the same for both the loss carryback and the pipeline planning. And then I showed you that we can compare different permanent life insurance products, and then we have graphs as well. So this is a much simpler output than often what we show to the client, which is 20-page illustration with another 10 pages of the strategy. The corporate retirement strategy, if you're not familiar, is kind of like a deferred IFA where the client can use that policy to assign later on to access money, tax-free loans. And so we have the corporate retirement strategy. And what I've added to this is to also include excess CDA. So when we talked about the corporate IFA, we talked about the excess CDA. Well, now I've incorporated the excess CDA for the corporate retirement strategy as well. And then I also show the shareholder borrowing to include the guarantee fees in the calculations. And because we've been selling par, we brought it back onto our product shelf in 2010. We've been getting more requests for these corporate retirement strategies for in-force par policies. So that we now have a model available for this as well. And it includes graphs. So because our illustrations where it don't have graphs, I find the graph can tell you immediately. For example, here you'll see the net estate values of the retirement strategy versus that alternate investment at 5%, that the insurance is going to be way exceed those values of the alternate investment for the life, pretty much the life of the policy, except at age 100. And also what I have is new is that you can also index the income. So if a client wants to see, at age 65, I want to be able to take out $50,000 a year, but because they want to index income at, say, 3% a year to have a growing income in their pocket over time, this model now incorporates that as well, and that's new. You may have seen our corporate asset transfer, and that starts off with the initial balance. Client has, in this example, $2 million just sitting in their holdco earning a certain amount. And then we talk about allocating a portion of that into insurance. Well, in this case, now we have more flexibility with the tool in that they may have $2 million sitting in the holdco, but they also have additional income coming in every single year. And so we can show that with the initial balance plus the new deposits of all that money staying additional investment. And we can also show a portion of that being transferred into insurance and doesn't even have to equal the same as those new deposits. You can set any amount you want. So it's a lot more flexible. So in this case, it was $2 million with $750,000 new money going in for the next 10 years. But they were going to buy a par policy that cost $625,000 for 10 years. So at life expectancy, they see that the net to shareholder, the internal rate of return on that traditional investment was 1.8%. And then on the state, including the insurance, you've more than doubled your IRRs, and now it's 3.7%. So when you look at the strategy advantage on the very right column, they now have more than doubled their net to estate. So there's a lot of information to digest there, but if you reach out to your regional sales director, they can also run all of these tools for you that you see fit. We don't want that shareholder IFA going out there, so I actually can't share that yet. Our risk and compliance don't want us to be promoting this, as we see a lot of risk in this tool, but all the other are available if you think that it may be appropriate for your client. So I thank you for your time, and I do appreciate any kind of feedback. So if you want to use your camera and take a shot of this QR code on the left, I appreciate any feedback on how you found today's session. So now I welcome any questions. Viola, if anyone has any questions.
Thank you so much, Helen, for your excellent presentation. So we did have some questions with regards to access to the tools. And I think for the most part, they are not available for advisors directly, but through people like me.
And I'll explain why, because every time I build a model, it goes through stringent review by our risk and compliance. I mean, you may, when dealing with all the companies, we often hear that Sunlife is the most conservative. So it goes through a lot of review. So for me to make it available to the advisors, it may take years of review to get it finally. So for now, I find that just getting it out to the wholesalers that they can use to run for you, and that way they can offer their support to work on the casework and work with you on these cases, then there may be actually more value in that.
Mm-hmm. Thank you for that explanation, Helen. And I think some were asking for copies of the presentation, which for sure we'll share later on. I think so far we don't have any questions right now. Let me just see if, we do have one individual who has put their hand up. Let me see. Let me just allow that individual to talk.
Sure.
Hi there.
Can you unmute them or?
Can ask to unmute. Okay.
Li Chen.
And
Yes, 那个 Viola， 我就用汉语问啊。我刚刚进来，我进来晚了，没有听前面的。我听到了，就是说，Sunlife 可以有一个term 的，是可以 convert， 可以 back to original age。我以前还不知道，它这个 back to original age 有什么条件吗？是几年以内的 term， 还是说任何时候我都可以 original？用它的那个年龄转变成一个那个 par 产品呢？
So Helen, the question refers to original age convert term policies. What are the requirements? How does that work?
Okay, so whenever you submit a term policy, it used to only be limited to a T10, but from what I've heard, it can now relate to any term policy you submit on your client that is over $5 million of face. So you just, when you send it in, you request that you want the original age conversion ability put into the contract so that later on they can actually track. The reason why they want to do this, they don't want everyone doing it. And you don't see a lot of people doing it anyways, but they want to be able to track who asked for it in case, because it is a very manual process. And so they want to be able to make sure that they are monitoring it properly.
So the coverage limitation convert to par is 5 million.
Yeah. Yes.
Okay.
I know, so, very, very large. I think it should be closer to 10, but they set it really high because they don't want a lot of people doing it. But because we know that other companies like Canada Life do offer this ability. And so we've had some of our top advisors ask for. And so
such as if the client has a 10 million term and transfer part term, such as 5 million to par, that's it? Part of, not whole term.
Yes. So not the whole term, as long as you're converting 5 million. So if you do have one that you've sold in the past year or even so, maybe you can come back and say, can we put this into the contract? And we can see what we can do if you believe that the client would find value in it.
Okay. Another question is, because I'm late to enter the access your training. So you mentioned the switch on IFA. What's the meaning double IFA?
Yeah, that one's really complicated, but I've seen one advisor do it and I don't recommend it, but it's kind of like you're buying a policy personally, borrowing back the money, lending it to the corporation, your corporation, and using that money to buy another insurance policy and then borrowing against that to reinvest back into the company. So now you have two IFAs, two policies.
Okay, two IFA, two policies. One is personal, another is corporation, right?
Right. So because the personal one lent it to the corporation to buy another policy, there are no deductions because they're not reinvesting to earn income. So you only really get the deduction on the second IFA.
Okay, thank
I
you.
don't recommend it.
Thank you, Sophia. So I think we have a question from the Q&A chat box. The question is, could you please elaborate a bit more on debt for business owners in terms of postmortem planning and how to mitigate that via loss carryback planning?
Sure. So often business owners don't do any planning, or they might just say, oh, I leave everything to my kids. Now, what happens is that even if they just said, oh, I leave everything to my kids, sure, the kids inherit the corporation, but they actually often don't want the business. So when that happens is that when they try to take all the money out of the corporation, they haven't implemented the loss carryback or the pipeline planning to eliminate one tax. So they could be subject to both shareholder dividend tax. So let's talk about, let's say they have $10 million in the corp and it'll be taxed as a capital gain to the deceased estate. So they will have to pay capital gains tax rate of, let's say, 25%. And then the money sits in there for the kids, and the kids say, well, I don't want the corporation, I just want the money. So then when the money comes out, the kids have to pay shareholder dividend tax on the same 10 million. So they could be subject to 70% taxes. However, you rely on the client's accountant to do some postmortem planning to eliminate one of those taxes. And they could do a combination of loss carryback and pipe, depending on which assets, but they're to work with the client, the accountants on that. And I would never say in the will, oh, I'm going to do pipeline planning, because a few years ago, we were CRA was going to eliminate pipeline planning. So we just want to make sure that the accountant is responsible for finding the most tax effective way to extract that money to the beneficiaries.
Thank you so much, Helen. 好，那我们看看有没有其他的问题。
Viola，今天的东西我们在哪里可以找到？讲的这些在网站上哪个地方可以看到，或者更详细的一些东西呢？
我们会把 follow up email， 我们会在 follow up email 里头给大家更多的文件，然后可以看一下。然后今天的讲座也有录像的，所以我们也 link 给大家，所以你可以重看。
对，因为讲座呢还是比较那个 summary 的，就是比较那个。